It feels like we are just constantly bombarded in the financial world with these big stories.
The narratives about finding the next big thing.
Exactly. Find the next big winner, the undiscovered disruptor, the genius stock pick, the moonshot opportunity. Conventional wisdom says if you're not chasing that, you're failing.
But the sources we're diving into today suggest that search for genius is not only a distraction, it's often the primary cause of financial disaster, especially for people who've already spent decades building their foundation.
Right.
That's the core idea here. Our mission in this deep dive is really specific. We're looking at wealth creation, but through the lens of longevity. So focusing on investors in, say, the 50-plus age bracket.
A completely different game.
It is. It's a deep exploration into that necessary shift from a high-risk offensive strategy to a defensive error-avoiding one. We're extracting these actionable principles based on decades of market observation. And the simple, maybe difficult truth is that durable success isn't about being a genius. It's about consistently avoiding stupidity.
I really appreciate that framing. I mean, avoiding catastrophe sounds a lot less stressful than trying to outsmart the market every single quarter.
It is.
So today we're going to unpack why survival's the ultimate strategy once time starts running short. We'll examine the unique, corrosive nature of envy, and then we'll drill down into the surprising path toward building truly foundational capital. Let's get started. Okay, so let's begin with this strategic reality shift that happens around age 50. In our 20s and 30s, we're always told to take huge risks.
Right, because you have an infinite runway to recover.
Exactly. If you lose big, you just, work for another 30 years and try again.
Sure.
But the sources make it explicitly clear that after 50, that flexibility, it just evaporates.
It absolutely does. By that stage, most of the major life variables are kind of locked in. Your career path, family expenses, where you live, they're mostly settled.
So if you take extreme risks now,
You're essentially gambling with the savings you need to live on. That's fundamentally different from gambling with future income you haven't earned yet. The focus has to transition entirely to defense. Time, which was your greatest ally in your 30s, becomes your worst enemy.
and this transition really highlights the true enemy, catastrophic failure. We should probably define what that actually looks like for someone post-50. It's not just mediocre returns.
No, not at all. It's the kind of loss you just can't recover from. Losing, say, 50% of your assets at 35 is painful, no question. But you have 3 decades of work ahead of you to recover.
But it's 65.
Losing 50% at 65 is an existential threat. This is where we get into something called sequence of returns risk. If you start taking money out of your portfolio right before or during a big downturn, think 2008 or 2000, that combination of losses and withdrawals just decimates your capital. Recovery becomes mathematically improbable. Defense means protecting that capital base above all else.
That makes the stakes so much higher. It's not about seeking high returns anymore. It's about ensuring survival. And the sources, they give this really poignant anecdote about how even smart people fail this test. Tell us about that Ivy League individual.
Oh, it's a classic case of hubris. You have this person, highly educated, extremely successful in a traditional field, completely secure financially.
Right.
And yet at 55, he's looking at the late 90s tech boom and just gets this profound sense of, well, FOMO, fear of missing out. He believed his intelligence in one field meant he could spot the next winner in another.
The ultimate trap. Transferring competence from, say, law or medicine into the highly specialized world of speculative investing.
Precisely. He assumed because he was smart in one area, he was smart in all areas. So he poured a huge chunk of his net worth, which should have been his defensive capital, into highly speculative, late-stage internet startups.
And we all know how that story ends.
By the 2002 crash, he had lost well over half of his assets, just gone. He spent his retirement years not enjoying his freedom, but mourning the fortune he destroyed through arrogance.
And the sources contrast that with just investing in boring, reliable companies.
Exactly. The stability of a Coca-Cola, a Procter & Gamble, or a Johnson & Johnson. Unexciting, yes. But security is the goal when recovery time is limited.
So the core rule is?
The ultimate defensive rule for the older investor is crystal clear. Figure out what will bankrupt you and then avoid it. It's a subtractive strategy, not an additive one.
And that avoidance means steering clear of 3 big things: leverage, speculation, and complexity.
Leverage debt is just poison. It amplifies every single mistake. When the market falls 20%, if you're 2-to-1 leveraged, you've just lost 40% of your equity. At 60, that's devastating.
And speculation.
Look, you can't, working part-time, out-trade a 25-year-old staring at 6 monitors all day. You just can't. And complexity. Complexity is just camouflage for risk. If you can't explain your investment to a smart teenager, it's too complex. The strategy has to remain relentlessly, reliably boring.
Okay, so we've established the external rules of defense, avoiding debt, avoiding speculation. But the sources reveal that the true saboteurs are their internal psychological
Right,
forces.
the behavioral poisons that cause even smart people to just abandon their perfectly good plans.
And the most insidious of these, because it's so purely destructive, is envy, jealousy.
It's unique among the deadly sins, as the sources highlight, because you get absolutely zero pleasure from it. Gluttony provides flavor, greed provides material gain, lust, well, it provides temporary satisfaction.
Temporary kick, at least.
Yeah, envy is just pure self-inflicted pain aimed at someone else's success. That's it.
And it is so infectious. You could have a perfectly healthy portfolio compounding away at 8% a year. But the moment your neighbor buys a luxury car with some lucky stock gain,
Or your brother-in-law boasts at Thanksgiving about some crypto coin that went 10x.
suddenly your stable, disciplined strategy feels wrong. You feel like a failure.
That impulse to catch up is lethal later in life. We see this so vividly in the golf buddy example from the material. Here was this financially secure investor doing everything right.
A model citizen, financially.
Totally. But he couldn't handle the locker room, talk about his buddies making easy money on oil stocks in the mid-2000s. He got envious, felt he had to join in, and this is the worst part. He used leverage to try and scale up fast.
So he went from a disciplined investor to an emotional speculator.
All because he let someone else's game define his own strategy. And when oil prices inevitably dropped, his leverage portfolio just collapsed. He was forced to sell at the bottom.
What about his friends?
They took losses, sure, but because they hadn't used leverage and still had their careers, they recovered. The envious investor, though, he lost decades of patience in one panicked move. The insight is crucial. The game is not about beating others, it's about finishing your own race.
That leads perfectly into the second poison. Overconfidence. Often disguised as the need to have a prediction about everything.
Right, this constant desire for intellectual validation. Why do smart people feel they have to have an opinion on the Fed's next move or the price of oil?
When the data shows most of those predictions are wrong 90% of the time.
Exactly. The market is just too complex, too random. Wealth isn't built by knowing everything. It's built by knowing the boundaries of your own competence.
And we saw this with that successful LA lawyer.
Oh, a heartbreaking story. He was at the absolute top of his legal field. Highly paid, highly respected. He reads a few sophisticated articles on global finance and convinces himself he understands currency markets.
So he decides to place a massive leveraged short bet against the Japanese yen.
Effectively convinced he could beat central banks at their own game after a weekend of reading.
It wasn't a lack of intelligence then.
Not at all. It was the cognitive trap of transferring expertise. He assumed his high intelligence in law translated directly into foresight in currency trading. When the yen moved against him, he was wiped out. His overconfidence cost him his retirement. The wisdom here is just having the humility to say, I don't know.
And the final behavior that sabotages us, impatience. Specifically, selling winners too soon and holding losers too long. It's the exact opposite of what you should do.
It's a profound psychological failure. Selling a winner, locking in a profit gives us this little dopamine hit. It feels safe. But if you find a truly great business, selling it is the single biggest opportunity cost you will ever incur.
And holding a loser.
Holding a loser feels like keeping hope alive. Selling is admitting you're wrong, and we hate doing that.
I can personally attest to this. Years ago, I invested a small sum in a business I knew was solid, but was trading cheap. I sold it after 6 months for a decent gain, and I was thrilled I'd beat the market.
And if you had held,
Had I just sat on that investment for the next 5 years, it would have quintupled my original net worth.
I wasn't wrong about the business. I just lacked the discipline to let a good thing become a great thing.
That failure of discipline is more common than any stock-picking mistake. So the takeaway is, find a truly great business and then sit tight. Your job is to avoid panic selling based on short-term noise.
Let's shift our focus now to the characteristics that build durable prosperity. Moving beyond just avoiding mistakes to actively building something that lasts, the material draws this fundamental distinction between the professionalism trap and the ownership mindset.
This is a crucial distinction, especially for high-income earners. Professionalism means optimizing for status, salary, perks. It's a high-end treadmill. You might earn $500,000 a year, but you're still exchanging time for money. The moment you stop working, the money stops.
And that's amplified by lifestyle inflation, right? The need to display that status means you're always consuming, always needing that high income just to keep up. Absolutely. The consumption driven by status forces you to stay on that treadmill. Ownership, on the other hand, is having assets that make money while you sleep.
Like what?
Profitable businesses, low-cost index funds, dividend stocks, rental properties, assets that generate cash flow whether you show up to work or not. The advice in the sources is clear. After 50, you have to stop playing the career game and fully transition to building ownership.
So the key question is,
The question you must ask yourself every day is, do I own anything that works for me when I don't show up?
that focus shift connects directly to the brutal reality of building that first chunk of capital, first $100,000. Why is that milestone so much harder than the rest?
Because compounding is an incredible force, but it is painfully slow until it hits a critical mass. Before you reach that, say, $100,000 threshold, every single dollar gained feels like sweat equity. You are funding the whole thing with your own labor.
So for most people, that takes a decade, maybe more.
About 10 years of relentless saving and restraint. Yeah, the first $100,000 isn't valuable because it makes you rich. It's valuable because it proves you have the character, the persistence, and the restraint to succeed long term.
After that, the money starts working for you.
Exactly. The returns start contributing meaningfully, and compounding finally starts to accelerate. But you have to survive that initial decade of grinding away to earn the right to harness that power.
And if we're talking about restraint, we have to circle back to debt. The sources are so clear on this, drawing from lessons like the Great Depression.
The lesson is timeless. Debt is poison. It amplifies stupidity and ensures you're fragile when bad times arrive, and they always do. Using debt for consumption, a luxury car, a bigger house you don't need, is the anti-compounding force. It's quietly, relentlessly working against you every single day.
So summarizing the path to durable prosperity, it really just comes down to simplicity and subtraction.
It truly does. The successful habits distilled from the sources are simple. Avoid debt. Avoid drama. That means reckless behaviors, bad divorces, impulsive decisions driven by ego. And avoid dealing with stupid people, meaning those who are unreliable or reckless because their poor decisions eventually become your problem.
This whole deep dive has laid out a core contradiction.
Yeah.
The idea that building wealth is fundamentally simple. Earn more than you spend, invest the difference wisely, but the execution is incredibly difficult.
It is, because it requires profound patience and restraint. And those are two qualities that human nature and, frankly, modern society actively fight against.
That is the essential conflict.
You don't need to be a genius or come from a privileged background to get rich. You need persistence. The world rewards those who consistently avoid being stupid far more than it rewards momentary flashes of brilliance. By focusing on defense and controlling your own psychology, you bypass 90% of the risks out there.
Which leaves the listener with a final thought to mull over. If you spend less than you earn, invest that difference wisely and boringly, and avoid the traps of envy and drama, you've already secured a winning position in the financial game.
So when you look forward 20 years, the choice is simple. Do you want to spend your retirement years envying your neighbor's momentary toys? Or do you want to quietly enjoy your own hard-won financial freedom? The path to that freedom is paved with consistent, predictable, and frankly persistent boredom.